This is William Richardson, the original money doctor, the voice of reason, with the financial checkup and question of the day. Here with my daughter, Esther. Esther, how you doing today?
Hi, Dad. I'm great. I can't wait to hear our next question.
Well, you're the one that gives it, so let's have it.
The question of the day comes from emails, messages, callers, and personal contact. Today's question is, what is the difference between a CD and annuity?
A CD? What is a CD, Esther?
A CD is a disc that you can insert and play it.
Well, actually, that's a term for a CD, but what they're talking about is a CD that is at a bank, and the difference between that and our financial vehicle, the annuity. So we'll get into that, but listen, you'll learn something on this one.
Great. I can't wait.
Oh, great. So how many of you know what a CD is? Is it something that we play, or is it a certificate of deposit from your local bank or credit union? What's the difference between a CD and an annuity? Do they play different? They actually do. They have some things that are in common. And let me talk about what they have in common first before we talk about what the differences are, because there is great difference in protection. So in common is you look for a CD because you're looking for protection of your money. You want to make sure that your principal is never taken away, and you're looking for predictability of what the interest rate is. And you're typically on a term 1 to 2 to 5 years, as far as 10 years on a CD. And you're looking for that predictable rate of return. What happens though, and in our current environment, is you're not being paid enough money on that rate of return, and you're really losing to what's happening with the economy and what's happening to what it costs you to buy things. So inflation is really eroding at what your return is. Now on the annuity side, why do people go to an annuity? It's very similar. They're going to the annuity for the protection that's behind the insurance company that's backing their money. They're going to the insurance company for the rate of return. And typically you can get a little higher rate of return on an annuity than you can on the CD. And then on the annuity side, you have an ability to have a fixed rate of return like you do on the CD. But then you also have some other benefits that allow you to have a continuous payouts, or to annuitize the annuity to have a lifetime payout that you can't outlive, that has some tax benefits associated with it. But typically most people are going between an annuity and a CD, and you'll see a lot of people move from a CD to the annuity to have a little higher rate of return. They don't really need the money, so it's there growing. Some people have huge amounts of money in the bank. And if you really look what's happening with the banking industry, underneath the surface, not what you're seeing on your nightly media news, things that you can find more deeper on the internet or on my world report at moneydoctoradvisor.com. Really what's happening with banks and what potential risk you have if we have a financial crash again, what's going to happen to the banks. Now we can look what happened in other countries and see, will that happen here in America? And most people say, no, that can never happen here. We have the FDIC, we have the government backing. We'll never let that particular situation happen in the US as it happened in other places. But as it happened on a smaller scale, it did. It did happen back in 2008. We had failures of banks. Now what happened? The government came in and bailed those institutions out, and they paid the money back, and they all made a whole lot of money and didn't hurt the banks at all. But who did it hurt? It hurt the common man. It hurt the average American family that got caught up in that. So those who had their money in annuities for the same reason that they had money in CDs, did they lose any money? No, actually they didn't, because of the structure of how a life insurance company is structured on a dollar for dollar basis. So the founding principle of the way a bank is set up and an insurance company of life insurance is a little different if you're not familiar with that. So your banking institutions have a smaller amount of money that they have to hold on reserves than your insurance company does. So an insurance company has to keep dollar for dollar. And what that means is, very simply, if they take in a dollar, that dollar actually goes into their general account and they don't spend it. So at any one day, all of their depositors or their insureds, all of their debts, all their liabilities, they have to have the money every single day to pay that off. Now, do you think your bank has to have all the money every single day in the reserves to pay off all their depositors, all their debts? Actually, they don't. And if you look that up, you'll be very surprised for how low that it is. So if you're looking at, 30% on the dollar, does that make you comfortable? Or does 100% on a dollar make you more comfortable? It really decides where you want your money, what you're trying to look for. For short-term, CDs could work for you. Are there short-term annuities? Typically, you're going to be in an annuity for 5 years. You can find some 3 years, but you're really looking for 5 to 10 years. It's a long-term investment, stability, rate of return, and we're always trying to look to see if we can kind of be in the 5% range. If you're looking at an annuity, you're there for protection, you're there for safety of principal, you really don't want to risk your money. That's why you're not in the stock market. If you were in the stock market, you're looking for a higher rate of return and you're willing to do what? To take a risk. A CD annuity, you don't want risk. You're hoping that the institutions that you have your money in are going to be secure, invest your money properly, and have it there for you in return. So you simply could look at, if we go to, let's say, the senior market, those who are in retirement already. What do they have? They have large amounts of money in fixed assets, CDs, annuities, bonds, and they're hoping for that to be a fixed rate of return so they can have an income, so they can have a check on a monthly basis, maybe along with their Social Security, if they have that. And so they have this paycheck, and what they're looking for really is what's called predictability. They don't want any worries of what's going to happen with income in retirement. So when you're on a fixed income, whether that fixed income is $2,000 a month or $100,000 a month, your lifestyle is situated in where you're expecting that money to come in on a monthly basis to pay for what you want to do. And what determines if you have $2,000 or $100,000 in retirement? Is it how much money you actually made prior to that? Some of it does, but a lot of it has to do with how disciplined you were and where you put your money and how you accessed your money throughout that time. So if you're putting your money into an annuity, and there's different types of annuities, some annuities you have an opportunity to have the upside of the stock market with none of the downside play. So that's interesting to some people, a little different than their fixed CDs. And typically though, we see that if you're looking at an annuity versus a CD, you may be interested in looking into a life insurance contract that will allow you to have your money grow and have that money grow tax-free, because both your CD, you're going to pay tax on earned income, your annuity is going to grow tax deferred, and when you take it out, you're going to pay taxes on it. But if you can go to an insurance company and actually have your money grow tax-free, and then have the ability to borrow from that money and use that to purchase what you're wanting to do. Now, you may not be able to pay money back in your retirement phase. So what do you want to do? You really want to look at how long is your money going to last. So your CD at your low rates, you're probably going to run out of money, maybe 10 years sooner. Your annuity, you may get there a little sooner. Maybe one of your brokerage accounts, it may run out in between that. But your longest time you're going to look at is really if you have a proper structured insurance contract that you can borrow from and have that money grow at a rate of return and capitalize on it and be able to structure that you can use your money 3 times. And always remember, you may live longer than you think, so the money you have may not be enough. So with that said, always remember to follow the 10-10-80% rule, and until we meet again, keep your money safe.
This is Esther Richardson, and you're listening to The Original Money Doctor with the financial checkup of the day. Ask about our educational, private, and public online seminars, video series, and live broadcasting events. Visit the event calendar at moneydoctoradvisor.com.
Living with purpose and real intent. If you're as concerned as I am, and you're not the type to sit around and wait for something to happen, there's something you can do. Special gift invitation. How to get growth, protection, and income for your money. Send a request for a special promo code to watch this new online video training series absolutely free in the comfort of your home or office. You will learn how hardworking American families protect and control their retirement money and never expose it to stock market risk or massive taxation. Watch this free video series and learn the rules. Send requests to info@citizensfinancialsecurity.com. That's info@citizensfinancialsecurity.com to view video online. Video series is shared as a public benefit for enlightenment.
You've been listening to The Original Money Doctor, inspiring you to rise above it all and plan ahead with guaranteed success. William F. Richardson is The Original Money Doctor. Tune in next week, same time, same channel, 105.5.